based on your personal circumstances. So, throughout all of this, it's, best to talk to your advisor or get in contact with us if there are any questions related to your personal situation. I can see lots of you already know me, so I will skip over my bio, but yeah, lots of you will have known me or have seen me because, I've been around with AWM for a long time now. So the agenda is exactly the same as, I've carried on the theme of tax year-end webinars for the last sort of 4 years, so it's exactly the same agenda and structure as the previous. Just a recap on when it is, what to think about, and how you can utilise allowances. So the end of the tax year is 5th of April, and start of new tax year, which is 25-26, the 6th of April. And that doesn't ever change. So, the things you should really be thinking about between now and then is, what is your total income earned to date? And that has implications on things like allowances, savings allowances. Also, you should be looking at how much interest you've earned. Different sort of scenario to the last couple of years because, people are earning significant sums of interest now. The return profile of your investments is relevant to, how they're wrapped up, what is actually being received, dividends, interest, or are you accumulating gains? Because it's important to understand the tax sort of implications of those. Savings and interest earned, I've added in. I've added that in because I've got a few things at the end of this webinar, to look at, how are you earning your interest? And we'll talk about that more at the end. Pension and other tax wrappers, obviously, pensions have an allowance, and then rolling into sort of gifting, so that's along the lines of inheritance tax. So, very small there. I don't know why it's come up so small, but, the allowances to 24-25, if we all watch the budget, they've been frozen, and there weren't any changes to sort of personal taxation as such from the budget in October. So the only difference, we have and that came in was on capital gains tax rates. So again, recap that at the end. I'll get a slide in more detail on that, but that was, that is as of, gains realised and made on the 30th of October 2024 and onwards. So, you can't go back and sort of realise gains now and try and use the old rates because they were implemented on the day of the budget. So as of midnight the night before, anything realised after that date is at the new rates. I will just recap that, but so you've got personal allowance, that's the, each UK individual has that, so that's the amount you can earn each tax year free of tax, free of income tax. So that, has been frozen, it remains frozen, and that number is 12,570. The starting rate for savings is one, an uncommon one that everyone talks about, but a really important one. So for individuals that, their income falls within their personal allowance, i.e. you are not liable for any income tax in the year, you can utilise a starting rate for savings. So it is £5,000. It not changing, hasn't changed. So what that does is, example being someone only earning state pension keeps within the personal allowance. If the rest of their money is, in savings account and i.e. cash, so they've only earned interest, that interest and state pension up to 17,570 is tax free. We then have a personal savings allowance, and it's again only for interest. So that is £1,000 for basic rate taxpayers, 500 for high rate, and 0 for additional rate. Dividend allowance down to £5,000 as of April 24, and the annual exempt amount for capital gains was reduced to £3,000 again in April 2024. So those are the current rates that you're working with now, and doesn't change until April 2028. So, we've got another few tax years of that being the fixed allowances that you have, each per person each tax year. So where should you save? So these are, the most common tax wrappers, as we call them. So ISAs are the tax-free savings. An ISA allowance of £20,000 per adult per year exists, and for juniors, so for under 18s, you can invest in a junior ISA up to £9,000 a year. The income and gains received within the ISA are tax-free, and there's no capital gains consideration on realising those gains and withdrawing from the ISA. So number one, fund your ISA. ISAs are generally flexible, so money can come in and out of them. A range of different ISA investment opportunities. So you have cash, you have investments, so stocks and shares ISAs. And then we offer a range of innovative finance ISAs that do some sort of alternative structures. So that is an ISA. A pension, again, that pension hasn't been changed. I don't think that's to say it won't be changed or reviewed. But as of now, your annual allowance remains at £60,000 or your earned interest. Earned income. That is then tapered still, and the taper could bring, the maximum taper is £10,000. So that again is on your personal situations and your total earned income over the year. If you are a non-earner, so you don't have any earned income, the maximum that can be contributed is £3,600. A pension, the money, you get the tax relief on the way in. So, for example, that £3,600 that can go into the pension for a non-taxpayer. It actually costs £2,880 to the individual, and then there's a £720 uplift rebate from HMRC that adds sort of basic rate tax relief to the contribution. Once the money's in a pension, there is no tax, so there is no, the pension itself doesn't pay income tax on gains and income received within the underlying investments. So both of those are, very sort of simple ways to tax plan. Tapered annual allowance, as I said, so tapered annual allowance again hasn't changed. So this is my slide from last year. So it is based on, £2 of income over 260,000, and it takes £1 off of that £60,000 maximum. Adjusted net income. The reason this is in here is because obviously, earned income over 100,000, so between 100 and 125,000, that income, so every £2 you earn in that bracket takes £1 off your personal allowance. So the reason I state adjusted net income is because a pension contribution can reduce your adjusted net income there, and that is useful for things, like personal allowance, claiming child benefits, and sort of multitude of other things. So pension contributions do come, when we look at a tax basis or an income calculation, the gross amount of a pension contribution can be deducted, which would then provide your adjusted net income. Tax incentivized schemes. So, one thing we are confident, at AWM is that tax incentivized schemes are going to continue. Rachel Reeves is in support of, UK entrepreneurship, UK businesses, and ultimately these schemes do support that. So a venture capital trust, in a nutshell, has 30% income tax relief. So for every £10,000 you buy or invest into a venture capital trust, upon your tax return, you would get £3,000 back. against income tax already paid. So you can't get an income tax rebate of tax you haven't paid in the year. So that's how that works. You can do up to £200,000 per person annually, and you have to hold them for 5 years. The return profile in venture capital trusts is in a form of a tax-free dividend. Becoming more and more attractive to lots of people, because it can actually provide a very, very tax-free income stream for lots of people who are looking for that income. Obviously, very high risk. This is not a guaranteed return, and you are investing in UK startup businesses. So that is, something to consider, but there are rewards for taking that risk in this environment. The others are EIS and SEIS. So EIS stands for Enterprise Investment Scheme. Again, so all the rates of relief are on there, so the slides will come to you after. But we have, a 30% or a 50% income tax relief. Your allowances, EIS is up to £1 million, SEIS is 200,000. They have a minimum hold of 3 years each, and so EIS defers capital gains taxes, potentially indefinitely, and SEIS scheme actually reduces 50% relief on the capital gains tax charge. The loss relief factor there, so the loss relief is that any losses you experience within a EIS or SEIS can be offset against your income tax liability in the year of the loss. So, the capital loss, if you're above a basic rate taxpayer, the capital loss being offset against income tax is actually, better than carrying losses. So capital gains tax, as I said, I've sort of had a slide on it. So the new rates that came in on the 30th of October are just normalised for, all assets now. So if the gain falls within your basic rate, so between 0 and 50,000, between 12 and 50,000 on an income, then, that rate is 18%. Historically would have been 10%. And the high rate is now 28%. So those are the two rates, and now there is no difference between, whether you're making a gain and realising a gain in shares, stock portfolio, anything on the investment side, or on residential property. So that is how capital gains tax has changed. The allowance is £3,000 per person. So again, there is no change to that. You cannot carry your allowances over years and years and years. So if you haven't had a £3,000 gain in this tax year, that will not then carry over to, after April the 5th. You can offset any losses against any gains. So, if you have had any capital losses, so if you've sold something at a loss, if you've realised a loss, in a property transaction, anything like that can be, should be noted. So there should be a note, you should maintain records of it, and you should keep notes of it, because they can be used against future gains. And that is an indefinite period. So, any losses you should keep note of and, maintain your records of. CGT allowances and strategies. So again, the same things. So interspousal transfers still exist. So, moving assets between spousal relationships is free of any taxes. So, if one party in the relationship has a big stock portfolio and the other doesn't, then balancing that out across the marital relationship may be a strategy for realizing more and more of that every year. You may be realizing that to put it into your ISA. So that's exactly what Bed and ISA is. It's using your unwrapped investments, realizing the position on those, and putting that into your ISA. Rebasing investments. So rebasing investments is essentially, intentionally transacting on a position. So, in a simple term, holding FTSE 100 stocks. So, for example, in mutual funds, if you held FTSE 100 stock managed by Vanguard, so you had the Vanguard FTSE 100 tracker. If you switch that into the Fidelity FTSE 100 tracker, for example, that would be rebasing your investments. So, you realize your position in one fund and you buy another fund, hopefully at the same price. There will be sort of a few days out the market while the transaction settles. But yes, if you rebase the investments and maintain your overall investment strategy and your overall position, but in rebasing, you essentially start the book cost of that investment again. Inheritance tax allowances. So, important one with changes to inheritance tax and, the pension being in the estate that's coming in very soon. So more and more people are looking at ways to, plan for potential inheritance tax liabilities. So everyone has a gifting allowance of £3,000. £3,000, can be gifted to anyone, including a trust, and that is your allowance every tax year. If you miss a tax year, so right now, if you didn't make a gift in 23-24, we're now in 24-25, you can roll that allowance you can roll it into this tax year, but only once. So after April, you can't look back more than one tax year to do that. There are other small gifting allowances, so, an unlimited amount of small gifts of £250, wedding gifts £5,000. And another one that, we're talking about more and more at the moment is gifting out of normal expenditure. So, why that's important for the end of the tax year is because the record keeping for gifting out of normal expenditure is essentially, working out your income, looking at your general spending and gifting the excess. The nature of how it's done can be quite admin heavy on the, record keeping basis of it. But, it's a good exercise to do now to kind of look per tax year what you've got coming in and what you've got going out. So that may give you an opportunity for next tax year planning, and the fact that, there is that scope for you to gift out of normal expenditure. Sort of planning that I think everyone should be looking at, might not be relevant to everyone, but, planning that everyone should be looking at is the following. So crucial one for anyone, let's say over the age of 45, really, is the state pension record, so your national insurance record. The 5th of April 2025 is the hard and final, I say, belief. I think it's hard and final, but it has been pushed back a few times now. But anyway, that date is the date where HMRC have said that the cutoff for repaying any contributions in your national insurance record from 2006 onwards. So that little table there is showing you the cost of, a week and a year, essentially in topping up your national insurance record. I would really, really encourage everyone to look at it. And reason being is that usually you can only look back 6 years. So if there are gaps, it is very worthwhile filling them. Again, I say very worthwhile for most people. Please do double check this either with one of us or the Future Pension Centre. But yes, usually, it usually costs £800 to £900 to buy your national insurance full year. Any additional year purchased gets you about, at current rates, £328.64 per year. So, if you survive three to 4 years, depending on your tax band, you have recouped your money. Can be very, very profitable exercise. State pension is, I say this, well, it's the only guaranteed return investment that, is inflation protected and everything else that, the state pension has with it. So yeah, really recommend people do that before the end of this tax year, because it could be quite a prosperous exercise to top up. Interest, as I said, becoming more and more important. It's becoming a more sizable chunk of people's actual annual incomes, and yeah, the interest rate's higher and cash has become more attractive. So that is just there a recap at the beginning. If you are someone that can claim the starting rate for savers, then it does make your it makes your tax-free allowance in that year £18,570 rather than £12,570. So those two allowances do give you an extra £6,000 of interest that can be earned tax-free. How you earn your interest though? So savings accounts, generally have two options. So, you can have fixed term accounts, you can have easy access accounts, and interest can either be paid at maturity or monthly. So when you are considering purchasing, a fixed term product, it is important to, actually look at the tax implications of doing so. So, £10,000 in a 5-year fixed account at 4%, you would earn £400. You would earn £400 annually. We assume that's within everyone's personal savings allowances. So, even an additional rate taxpayer would have £500 a year. So you actually earn £2,000 from that account. If you collect the money at maturity, the compounded, and this is, I've assumed it compounds annually as well. So the compounding effect has actually gained you £166 in interest. However, the taxation of that is all paid at maturity, so it all would happen in one tax year. That all happening in one tax year, it is, unless you fall within the category of people I previously showed, it is additional. Well, this is exceeding any personal savings allowance. So even though you compounded it, you've got more interest, you would then be liable for tax on that account. And it's something I don't think everyone considers when they look at it, but yeah, that you gain £166, but you would have to pay £233 in the year it was received if you're a basic rate payer, £666 if you're a higher rate, and if this was a savings account for an additional rate per taxpayer, it'd be £976. So you can see the impact on taxes the impact that tax does actually still have on these cash-based savings accounts. Premium bonds. Premium bonds I talk about a lot more than I ever have before. They are a lovely alternative to cash savings because the winnings are tax-free. So the interest/winnings you earn from premium bonds don't even need to be considered on tax returns and don't form part of any allowances that you have. So they are capped at £50,000 per person, and you can actually open a premium bond account for anyone. So grandchildren, nieces, nephews, children, brothers, sisters. You could open a premium bond account, with their authority if they're an adult, and start contributing to that for them. The reason I say for under 16 is important. So, junior ISAs have an allowance if you wanted to gift over and above that for, inheritance tax purposes. Premium bonds are great, a great place to do that because they don't impact anyone's tax position. So they are unwrapped, they are liquid cash. They're not ISAs, but they are, a very, very tax efficient way to hold the money. The current rate we are disclosed by NS&I is 3.8%. Depending on your tax position, that 3.8% could actually be really, really attractive as a net rate after potentially the impact of interest that I showed previously would be. And then finally, just putting in onshore offshore bonds. Onshore and offshore bonds is something you should talk to an advisor about. They are a bit more complex of a product, but what they essentially allow you to do is control the timing of taxation. So controlling the time of taxation means that essentially you put the money away, you're saving it for your future. You don't actually have to consider that on an annual basis or any consideration of the gains or income that's being made within the bond while it's invested for that fixed term, or while it's invested for that term you have sort of in mind. You can control when it's taxed by, I want money in next tax year, so you control the exact taxation point of it. And if we are, linking all of this back together, sort of gifting out of normal expenditure and gifting in general, assignment of bonds allows you to, push that tax event onto someone else, or, gift segments of your bond as that gifting out of normal expenditure. So those two things, can be effective in inheritance tax. An onshore and offshore bond is very efficient for high earners right now. And can be used for a multitude of things within sort of an overall financial plan. But as I say, complex products, not as simple as an ISA, unfortunately. But worth considering if you are talking to your advisor. And that brings me to the end of the presentation. So I see there were some questions.
Thanks, Claire. I think we actually had, or going quickly to Tim, I think had a couple of comments rather than questions, which we should probably hit out first. So we had, I believe the higher rate CGT for property is 24%, not 28%.
Yes, is my slide wrong? If it is wrong, I will correct it. But yes, the additional rate for everyone is 24%.
And don't forget spouses when considering topping up NI.
Very good point. Yeah, you can top up anyone's national insurance record. If you are married in retirement, a household income is important. So, very good point.
Thanks, Tim. And then a couple of questions did come through. So we've got Angela saying, is it worth mentioning that you can't put more into your pension after 75? I was caught out by this, and it has meant that I've gone from 20% tax to 14% tax on income.
So you could put money into a pension. You just don't qualify for tax relief after the age of 75. So yes. Very good point to note that, the tax relief, that I spoke of on the way in, so the contribution is only eligible for individuals up to the age of 75.
Okay. And then from Ben, we've got, does the tapered pension allowance apply if you have employer only contributions? Would those contributions also be subject to tax over the 10K allowance if the thresholds are met?
Yes, so probably a specific question, but yes, there's your adjusted income and your threshold income. So if you breach threshold income, the calculation to work out your taper actually adds back employer contributions. So that's factor number one, and your adjusted income for that purpose would determine your taper. And yes, if they are only employer contributions and they've breached your allowance, say it's it's 10K and your employer's put 20K into your pension, you would have an annual allowance tax charge on the excess, which is essentially your marginal rate. So you'd have your marginal rate tax due on the excess payment, is how that would work.
Lovely, thank you. We haven't got any other questions at the moment.